Welcome to you both. Michael Schumacher, we have a knack for talking to each other before these big Fed pivot points. Memorably, the hawkish one back in maybe March that really kicked things off. Why do you think they're going to stay the course now and this won't be a dovish surprise?
Yeah, Kelly, it's a function of taking out insurance. Jay Powell and friends are still confronting super high inflation. I think they're really losing confidence or have lost confidence in their ability to predict it. So that argues for hiking more, not less, even after the good report today. Unambiguously good for the Fed. The thing is, I think it changed very little in what Jay Powell is going to say tomorrow. He'll tell the market, we're not going to ease anytime soon. Yes, we like the progress, we like the direction, but there's a lot more work to do.
Yet, Steve, we see these signs of discord emerging within the Fed. We talked about the journal piece, obviously. You've hinted as well that, maybe this galvanizes some who might not be totally on board with more aggressive rate hikes to really push the case for pausing.
Yeah, and Powell does have to keep the committee together. I think he's okay to brook a little bit of dissent, but not a whole lot. But I don't think he really has that problem. I think there's, from the former doves, now they're all sort of turned into hawks. I mean, I don't think you're going to get a reversal from people like, Mary Daly from San Francisco, who's pegged 4 3/4 to 5 1/4 as her range for the peak funds rate. And I don't think guys like Neil Kashkari, who was previously a dove, now he's among the most hawkish out there. I don't think there's a whole lot of support for stopping here. I think when I look at the March contract, guys, I have this chart in the back that might be worth looking at. I think this might reflect where the Fed is as well. This is where the market is. Take a look for the debate over market. About 30% or 28% of folks see the Fed being done at, call it 462. That's about 75 basis points from here. Half of the market sees the Fed done in March at 488, and then another 19% say the Fed goes above 5. Guys, that's the first chart. The second chart, the bar chart, is the one I was after there. And that'll show, I think, Kelly, the dispersion in the market, probably in the Fed. But note that all of those numbers are higher from where they are here. And the way I like to describe it, very similar to the way Mr. Schumacher described it, is, if you're putting out a fire and you're by yourself, you pour 1 bucket of water. But if you're the park ranger, you're going to pour 5 buckets of water on it to make sure the damn thing is out. And that's what the Fed's going to do here.
Yeah, and I understand that, Michael, because we still have some wage pressures. But the market seems to be saying that monetary policy is already restrictive. Look at the yield curves. I mean, if you take that message seriously, they're telling us we're not just going into recession, but we're going into a deep one. Does the Fed have a responsibility here to try to keep that from happening?
Yeah, as far as the curve, Kelly, it's interesting. The curve was an excellent predictor of recessions, and we've got to be a little more clear about the curve. Market people usually talk about 2-year versus 10-year.
Sure.
The Fed likes something much shorter. But still, its predictive power is pretty limited, and I think that's largely right, exactly right. And that's the Fed's balance sheet has been so big, and I appreciate that it's shrinking, but that's really distorted that signal. So the Fed, in a way, it's almost circular. It's bought so many bonds, it's driven down long-term rates probably below where they should be fundamentally, and consequently it's not telling us much, that being the curve, about the prospects for growth. So I wouldn't say it's an omen of recession, but it does get people in the market worried, and it doesn't work very well, frankly, for financial markets to have such a super inverted curve.